Hey, Steve, welcome to the show.
Hey, thanks for having me.
So I've been looking forward to this conversation for a long time. I know you and I have connected offline before. You've got first off, a really cool entrepreneurial background, and then two, we'll dive into you as an investor in searchers and search funds. So give us a little bit of background about your entrepreneurial ventures.
Awesome. Well, thanks for having me. Excited to be on the podcast today, and just excited to connect with a great audience you have here. So, yeah, my background. I'll start first with kind of the entrepreneurial side, and then I'll kind of go into the investment side, which came a little later in life. So, I moved around a ton growing up. So I joke I was not a military brat, but I was an IRS brat, which is nobody loves taxes, but my dad worked at the tax agency, and so learned a lot about meeting new folks and new situations, and was passionate about public service. And then my mom's side's all entrepreneurs. So my grandfather randomly owned a first In-N-Out, kind of a fast food chain in Fort Collins, Colorado. You know, aluminum siding business and lots of businesses. And those two parts, kind of government and then entrepreneurship, kind of helped meld me to a career in government entrepreneurship. And so I went to Penn for grad school right out of college under a Homeland Security scholarship. I worked at Homeland Security and Technology for 5 years and really enjoyed my time there in public service. Eventually had an idea of basically a Facebook for government. So if you remember 08, 09, they had these news sites. There was one called Sermo, a social network for doctors. There was one for lawyers. And I thought, hey, wouldn't it be cool if there was a mini social network for government employees? And so that was the concept of govloop.com. And I founded it, bootstrapped it by myself, I had a 9 to 5 day job in government. This was my 5 to 9 hustle, and it grew and eventually left government, bootstrapped that business, and we sold the business pretty early on, about a year and a half after launch, to a company called GovDelivery. And GovDelivery was basically the MailChimp for government. So if you got an email or text message, say from like City of Salt Lake about a snow plow removal, or hey, you're actually in Texas and here's an email to renew your hunting license. That's from them. And I was lucky enough to be a number of roles, including the chief marketing officer, as we grew from about 7 million to 40 million of ARR. And we sold to a private equity firm called Vista Private Equity. And Vista's well known for having playbooks and running kind of great SaaS software companies. They even say all software tastes like chicken. And so they here's a way to run great businesses. And I learned a ton from them, but eventually wanted to do something smaller and became CEO of a small public safety software company called Collio, my friend had founded. And we had a fun journey as we grew from 2 to 8.5 million ARR and sold it to Motorola Solutions a little over a year ago. And so that's been kind of the core day of my entrepreneur journey. And I could talk more about investing, but I'll pause there.
Yeah, well, that's amazing, Steve. So what a background. So the first off, I love the balance of your dad was an IRS guy and your mom had this entrepreneurial background. A lot of those things, those things don't really mix that well usually, but that's pretty awesome. And so I'm sure it was probably news to a lot of your colleagues when you're working for the government and you said, I'm actually going to go start this company over here.
Yeah, everyone thought I was crazy, including my dad. So my dad thought it was a terrible idea, but like all of us, we never want to be our father. So I said, hey, the worst case, I'd done pretty well in the government career. So I was upper middle on this kind of 1 through 15 system. I was a 14 already at a pretty young age. And I said, I got nothing to lose if I go do this on my own, and it fails, worst case scenario, I'll come back in government in 3 years. And we'll do it from there, and then the rest was history. But it is an interesting thing, I think, for listeners. I think if you're not an entrepreneur and you get advice from folks that you care and love about that are quite smart, sometimes it can be the wrong advice, honestly. And so I think that's hard sometimes in your mind when people you trust and care about sometimes are telling you options. I think long term you can even look back and say probably weren't the right call. But if you're an entrepreneur at heart, you got to follow it.
Well, I think there's a lot, right, of what you said. And sometimes the advice that we get from people, we have to understand where the advice is coming from too. A lot of times It is coming from a place of love, but someone who's got a government career, they're always going to tell you to keep working for the government, or someone who's an entrepreneur is going to say, hey, keep rolling the dice, keep going for it, And so sometimes you have to ask yourself, where's this person's background in terms of the feedback that they're giving me? And so, and your mom and, it sounds like your grandpa on the other side were probably like, yeah, go for it. What's the downside? You just go back and get a job.
Yeah, no, and even on that side too, I have an aunt who's an entrepreneur, and she's more of that. She kind of, she's the type she bought a couple franchises and wanted to buy even more. Kind of roll the dice, and so it's funny. Everyone comes from a different spot, and I think a key part is knowing yourself, and then creating your own kind of roundtables of differing opinions, and then in the end, it's your life, so you decide what to do.
Yeah. And I like that you said, hey, what's the worst that can happen in a couple of years? If it doesn't work out, I've got some cool stories, cool experiences, and I'll go back and, maybe start a little bit lower than you were before, but you just go back and kind of get back into government. So, well, that's so incredibly successful entrepreneur. You've got a lot of fascinating, interesting things at backgrounds, and like a lot of 7 to 40 million, 2 to 8.5 or 9 million in ARR. Like that's just incredible. That's like, you've had multiple roller coaster rides that most rocket ships more so than people would kill just for one of those, right? And you've had several of these. Now, a lot of our conversation that we kind of talked about, Steve, was getting into the search fund community. And so how did you're an investor in the search fund community, you're pretty active, you do a lot of deals. I would love to dive in kind of the ins and outs, how you got into backing searchers, how you kind of got into this community, because you're one of the original people who've probably helped develop this community from what it is from 5 years ago compared to what it is today.
Yep. Yeah, it really started. I just always loved investing as well. So I was one of those kids that had a Roth IRA at like 12 years old and would mow lawns and put some let the tax father's like, this Roth IRA is great. You should put it put your $100 in. And so always loved investing. Classic kind of Vanguard Boglehead. And you kind of graduate in Buffett and Munger and some of the more advanced stuff, Constellation Software and the book The Outsiders by Thorndike. So always loved kind of the idea of value investing, buying great businesses. And then my time at Vista and then also at Collier, where I met a number of private equity firms, kind of got me thinking about, hey, how can you buy existing businesses, improve them? And then also private equity uses debt as an instrument. So also understanding how debt works as an instrument to buy businesses and grow businesses. So that kind of helped me learn kind of large cap private equity. And then I'd also at the same time done some angel investing in startups, both in DC, where I'm based, and GovTech, where I have a network. And the startup side kind of reminded me how much I loved helping entrepreneurs, right? So I love talking to folks like you, Ryan, who have an idea and they're working on it. But I realized I did not love the kind of 9 strikeouts for 1 grand slam. And so I heard about search through a friend that did it. And I said, hey, this feels one part kind of private equity, leverage buyout, value creation, Buffett buying great value businesses. And then it feels one part backing, supporting, mentoring great startup entrepreneurs. And so that's kind of how I got into search. And like a lot of folks, did the deep dive, right? You read all the books, yeah, you listen to the podcasts like this one, and you get involved with the website, Search Funder and Twitter, et cetera. And I really started enjoying it. I first started as an investor in a couple of search fund to funds. So there are kind of like mini private equity groups that invest in searchers. I invested in one called Footbridge Partners as a way to kind of get going. And then since then, I just started to talk to searchers, honestly, and meeting folks in the US and internationally, traditional, self-funded, and just really enjoyed getting to know folks in the space. And I partnered up with a good buddy also in DC, Alex Mears, who's large cap P's at Carlyle, Bain, but he's also a military veteran. So we backed a number of military veterans as well. And yeah, fast forward today, and we've backed over 25 traditional searchers, US and internationally. And we've done over 25 deals, traditional, self-funded, and just really love the community. It's a great, thoughtful, and collaborative group of folks.
No, I love that. I think with doing 25 deals or backing 25 searchers, you might be one of the most prolific search fund investors that there is. I don't know specific stats around that, but
I don't know. I don't know about that. There's definitely some OGs that have a lot more, but I've been really enjoying it, and then I like kind of sharing and passing on the knowledge both to new investors as well as to searchers.
Well, and with your background as an entrepreneur, you've kind of lived it and been in the shoes of many of these entrepreneurs. So, um, walk us through what a typical deal might look like. Or I guess maybe taking it a step back from there, Steve, is like, you have investors, you have searchers. People are pretty familiar with this set kind of setup in terms of the traditional model. What are what are some things that you look for in a searcher or in a particular deal?
Yeah, I mean, I would break it out. So in my mind, I think there's kind of four kind of markets I look at in search, and we'll kind of talk through, and then we'll go into the deal. So there's traditional search fund. So kind of out of classic MBA schools raising a traditional search fund, $400,000, a little bit more. There is search fund accelerators, which are the same concept, but one pool of capital, coming from groups like Search Fund Accelerator, Next Gen Growth. I'd say there's self-funded search using an SBA loan. So these are kind of $3 to $7 million deals using SBA as primary debt. And it's another group of investors, because any investor that owns up to 20% of the economic interest puts a PG on it. So no one wants to do that. So it's a group of investors. And then I'd say there's independent sponsor deals, which are self-funded but large deals. So think 10 to 50 million of enterprise value, often roll-ups, not using SBA, using conventional debt. So those are kind of the four groups I look at. To step back and say, what do you look for in the different groups? It really fits kind of depending on the group. So in traditional search, I think a lot of investors are looking for a few things, because you're betting on the person. So those they don't have a deal, so you can't evaluate the deal, right? And so you're looking for a couple different things. So one is just a really strong interest in search with realistic expectations of search. And so what does that look like? That means, hey, maybe they've interned at a search fund, maybe they've interned at a search fund to fund, maybe they worked at the ETA club, maybe they've talked to 50 searchers. Just a real understanding of like what this is going to be like, because as we know through this podcast, it's great to buy a business, but it's not all glamorous. There's up days and bad days, and sometimes it might be a little easier just working at Boston Consulting Group on the fancy name. And so you want to know folks that really want to do it. I think two, you want folks that have the kind of three basic skills I look for in businesses are like, can they find a deal sourcing? So do they know how to find a deal? Two, once they have a deal, do they know how to close a deal? That's kind of PE or closing deals. And then three, can they operate a business? Can they lead teams, manage people, manage a P&L? And so most search fund investors are looking for those three things. And sometimes you have a pair. And so one is the kind of consultant P&L person, one is the private equity banker deal sourcing. Or if it's just a solo searcher, understanding your gaps and how you're going to solve for those gaps. Maybe I'll pause there. Does that make sense on the kind of searcher side?
Yeah, absolutely. What I have actually found with searchers is what sometimes makes a searcher successful is not the same skill set as operating the business after the fact, right? And so you kind of have these skill sets that sort of translate, but a lot of times they're siloed and you're at different levels within your search. And so you kind of have to like, you're in the grind, you're looking at a lot of deals. It's a lot of technical analysis and understanding risk and understanding future growth. And then, fast forward a year or two down the road, you end up buying a company and you've got 10 employees or 20 employees or 50 employees and you've got a fleet of whatever. All of a sudden, that's a completely different skill set than what you were doing before. You could put the deal together, but that doesn't necessarily mean you can operate the business. And so you're operating under all these different levels and you're putting on all these different hats at different times, but you kind of have to be like better than average at all of these things to make it work.
Yeah, and you have to have the ability to learn those skills, right? So I think that's a big part. Are you able to learn those skills quickly along the process? And then I would say on the kind of the self-funded and independent sponsor side, you're kind of removing the kind of can they find a deal because they have a deal, right? So you're kind of removing that from the equation. So at that point, you're really just looking, is it a good deal? And does it kind of, does it fit? Honestly, the checklist at the back of the Harvard Red Book on buying a business is still probably the best. Is it low customer concentration, high recurring, low capex, tailwinds to the industry? All those kind of basic fundamentals of good search businesses, I think, is how you look at the deal. And then you kind of look at, are they a good fit for that business? So, hey, I have me buying another software business, clearly it fits with my background, but hey, maybe if it's buying a niche manufacturing business in Mississippi, you might say, hey, I don't know, does this guy in DC, is he going to fit in Mississippi? Does he know anything about manufacturing? Can he lead a team of blue collar, high end manufacturing skilled labor? So I think looking if the searcher fits for the business is kind of a second key point. And then third, trying to align on both terms and vision for the business. So what are we doing with this business together? Are you trying to build a big business and really grow it and invest for growth? Are you trying to hold this business forever and do it as kind of a cash cow and spit out dividends to investors every few years, but understanding what's the searcher's goal with the business and how do the terms align to that, and do they fit for the investor and the searcher?
Yeah, thanks for diving into that. I think there's so many moving pieces that some of these deals can make sense for certain investors or certain searchers, but sometimes you're kind of marrying up the same goals that investors will have with the same searchers and making sure that is all aligned. What if you had to pinpoint when you come to self-funded searchers, you've got a couple of different things that you're kind of diving into here based on that loan, based on the size, right? 3 to 7 million, 3 to 8 million is kind of where that a lot of times will hang out in. I personally see a lot of those deals usually run into a concentration of a region or suppliers or customers or some type of concentration. What do you normally see is like kind of the big red flag in that range of 3 to 7 million? And if they had to pinpoint it on one thing.
Yeah, so I'd say customer concentration is often the main issue, and you'll see one customer at 50% of the revenue, and that's pretty scary. Or if not a customer, a relationship. So sometimes it's not one customer, but hey, you're selling, I don't know, you're selling to construction, and there's kind of a middleman that actually is funneling all those customers. So concentration is a big risk, especially at that size. Where did the owner just kind of know that customer really well? Is there something really unique? And then the same on the talent side too, just kind of understanding what's the second layer of management, what's going on there, what happens when you pull that owner out. So sometimes you see, hey, the number 2 employee is actually married to the owner's sister, right? Oh, okay, I didn't see that from the last name. This is going to unravel. Or hey, was there always a promise to the number 2 that hey, he or she would get some equity eventually down the line, and that's the expectation going in. So just the people and management behind that, especially on companies that small, I think is another one I've seen folks run into.
Oh, interesting. And sometimes I don't think about the people, but ultimately you're buying a business that's all people, right? Every business out there, there's people behind it. And so you can get a couple layers deep and realize, hey, this is all tied into 2 people and their talent skill sets. Or it's really common that the owner has all the skill sets, but they've been doing it for 35 or 40 years or something like that.
Yeah, especially like 10 to 20 people. Sometimes you see in the trades where there's someone who kind of runs the team, of the trades. Maybe there's 2 pods, and that one person's actually the lever. And if you come in, that person's going to ask for a big raise or leave, and understanding how it all trickles down.
I laugh that you say that, because 100% of the people I know, and in my own situations where you've got into a situation where there's a manager or someone who's been there for 10 years or instrumental in running that business, 100% of the time, it seems like they either want a raise, a month or 2 in after you make the acquisition, or you have to be willing to maybe potentially replace them. So I don't know if you've seen that too.
Yeah, no, and it makes sense from their vantage point. I think it's always great to kind of put yourself in their shoes. So they built this business with this owner, and for 5-10 years, grew it. The owner sold it. Usually the GM or this person didn't get a big equity check, right? And now there's a new person coming in, and they're kind of like, what's going on here? I don't know. Should I leave? Should I not? I never made money on the first deal. And so it brings up a lot of things that I think are important to think through.
Yeah, and I don't fault them for doing that. I'd probably do the same thing. So
yeah, exactly.
So if you got an opportunity, you better seize it, right? So can you walk us through? You've done 25 deals. Walk us through maybe maybe a traditional search and then a self-funded search. What does it typically look like, the terms with investors and the entrepreneur, and just maybe kind of some averages? It doesn't need to be specific.
Yeah, so the beauty of traditional search is it's basically a set formula. It's all aligned kind of across, even the U.S. and internationally. About 50% of what I've done is international search, and the formula is basically you invest in the search, and that capital can be like 400 to 700,000 if it's single or double, and it funds that search for 2 years. That money, when a deal closes, is then stepped up, so that 400 becomes 600 and put into the deal, if that makes sense. So that translates into the deal. And then the searcher is usually gets up to 25% in basically a third instrument. So they get 8%, to make it simple, 8 1/3 for closing the deal. That's kind of like the finder's fee. Hey, you got the deal, you got your 8%. So even if you left, 6 months later, you got the 8. The second 8 is time vested over 4 years. So kind of classic, time vested over 4 years. And then the last 8% is based on a hurdle rate of 20 to 35%, where you get the remaining part of your equity. And it's 25% if it's solo, and it's 30% if it's two. So that's kind of the general frame of how that works. And then I'd say I'll kind of go 3 ways. In independent sponsor land, which are kind of these large non-SBA deals, there's usually a finder's fee. So these people are, they're not paid to search. So often they're kind of former private equity folks or operators in the space that maybe they just did a vet roll up as part of a PE fund. Now they want to do their own. And so they aren't paid to search, but when they have a deal, they usually get a transaction fee. It's like 1 to 2%. They usually get an EBITDA monitoring fee. So on the hold period, they usually get, say, 4 or 5% of the EBITDA. And then there's usually a hurdle, and then say like 20% above that. So that's kind of how those independent sponsor large deals work. And then on self-funded search using SBA, those deals honestly range a ton, and it's kind of a little bit of the wild west. But generally, what I see are kind of a couple rules of thumb. So I have like a template for self-funded search. I'm happy to share the Excel model to kind of help model this and kind of what you think would be fair. I generally recommend basically the searcher, the investor should basically model at a 35% IRR. So that's the top tranche of traditional search. So you should model there in a base case in self-funded search. And base case is same entry multiple and exit multiple. So assuming kind of the same multiple, same growth rate as the past. So it shouldn't go from growing 1% to 20. So it's basically base case, standard base case. And it should model there, and it should get there pretty easily, partly because self-funded search has a lot more debt. So it's usually 80%, 90% debt. And then you're usually buying at lower multiples. So you're buying at 4 or 5 times. Once again, why it should model so high too is also these are much riskier assets. The smaller the deal, think about it, a smaller deal with a lot of leverage is inherently pretty risky. Some other rules of thumbs as you kind of build out the economics for the investor are generally it should be kind of a 3 to 5x MOIC, or kind of return on capital in 3 to 5 years. So that will align with the IRR, but just in case some people IRR is time based. So if you kind of play funny games with IRR, you want to make sure it still hits on the MOIC hurdle. And and it's usually done in an instrument that's a preferred rate of return that converts into common. So that preferred will be like at 8 to 15%, and then the common is usually 20 to 50% to the investor. So usually the searcher's owning the majority of the economics on a self-funded search deal, assuming it's in that kind of $3 to $7 million range and and they're using the SBA debt. So in those deals, the searcher's taking on the debt, and that's part of the reason they're getting larger equities. They're taking on the personal guarantee.
Well, I think based on a couple of those breakdowns, right, you could see the pros and cons for both. If you're going to the traditional route, you typically have a salary, you've got investors already lined up. You're only going to end up with a smaller portion of the business, but at the same time, you're typically not taking on a lot of the debt, personal guarantee. On the independent side, you're typically doing much larger deals, and that's probably mainly for people, former private equity folks who probably aren't listening too much to this podcast. And then on the flip side is the self-funded, right, which is similar to traditional, but you don't necessarily have investors lined up. You're kind of on your own. You're funding it all yourself, which allows you to have a lot more upside, but you're also taking on a personal guarantee. And so I think when a searcher or an entrepreneur is trying to figure out what works for them, part of it's understanding their own risk tolerance, their own, runway, if they've got enough money
Yep.
saved up to be able to do it themselves. And then of course their network of investors and which path they want to go down. And so I don't think there's necessarily a right path. I think there's a right path depending upon the person. And so based on the pros and cons and how things can go, it allows the entrepreneur to kind of pick a path that makes the most sense for them.
Yeah. Yeah. I think they're both interesting paths. I think traditional, my simple is like smaller piece of a bigger pie, with world-class investors. So kind of generally a higher caliber of folks you normally wouldn't get on a large deal. And then you're also, it's different being a CEO of a 20 or $50 million, just kind of depending your career ambition. So it's just a different job in generally kind of a more ambitious way. And then self-funded is you're not paid to search, and you're getting a larger piece of a smaller pie, generally with the kind of less involved kind of high-end investors. But you kind of you run the show too, right? So it's a little bit more kind of in your freedom and well, so just a little depends. And I've seen traditional searchers. Some folks have done a traditional search and had success, then did a self-funded search. I've seen traditional searchers then do another traditional search. I've seen self-funded searchers who have done multiple self-funded deals. So there's all a bunch of varieties around it.
And it sounds like, if you've got people going back and doing the same one or changing it the second time around, it just depends on, the period of life that you might be in, or the skill sets that you're trying to build, or, sometimes you're trying to optimize for maximum exit, and other times you might be optimizing a little bit more for lifestyle, just based on, if you've got a family and kids and those types of things. So with only a couple of minutes left, Steve, walk us through, how appreciate from like the investor side, walk us through how a searcher should approach investors and start those conversations, and how should they think about that interaction with investors from day one?
Yeah, so I think a lot of interaction with investors is really just like any preparation for anything, a job interview, et cetera. You want to kind of have your story of why you're doing search, and you should practice it, right? And work on practicing it with if you have a partner or friends or family. So like why you're in search, what are you looking for? You should be able to tell your story in that kind of 3 minutes crisp, and how it leads to being a good searcher. I think once you have a deal, you should also be able to do the same with the deal, understanding the industry, the team, the financials, and your vision for it. So being clearly, methodically talk through your life and the deal is a key part. I think consistency is a big piece. I see the best searchers will do, they'll do things like, if they're raising traditional search, they'll connect with me a month before they write their PPM and say, hey, I'm looking to raise in a couple months. I'd love to get just 15 minutes to talk through your advice on writing a great PPM. Get advice, then they'll follow up with thanks for your advice, send you the draft, and then they'll go. And they're just consistent throughout. I would say even the best self-funded searchers are like that. They meet me before they have a deal, but might send a monthly update of where they are in the process. And so I think consistency in every interaction is key, and then kind of knowing your talk track both on the deal and yourself.
I love it. With when you think about raising money, it's same thing if you're working with a banker or trying to go down the SBA route. You don't want to wait till it's 3 weeks in and you've already got your LOI lined up. You want to start these conversations sooner rather than later. Some of these things may be on delay as you find the right deal and work through things. And some deals just take 6 months to find, and some take 2 years to find. It's kind of a wild, wild west in terms of identifying the time frame. So, Steve, where can people find you and follow you? And if they've got questions, or if they, if they're, want to find you, where can they find you?
Yeah, so I love helping out searchers, whether you're kind of early in the journey or have an active deal. My email is just sressler@gmail, RESSLER@gmail. I'm active on Twitter, twitter.com/Steve Ressler. I write a monthly newsletter on ETA and search. It's linked in my bio of Twitter, but it's bit.ly/ETA Musing. So please reach out if I can help you or someone you know in the search community. It's a fun collaborative community, and it's fun to see it grow, and appreciate you putting together this great podcast, Ryan.
Thanks, Steve, for joining us. And we'll link to all that there in the show notes.
Awesome. Thanks so much.